You're sitting across from a guy in a blazer, and he just told you that for $150 a month, you get life insurance and a savings account, all rolled into one. He's smiling the whole time, like this is the easiest decision you'll make all week. It sounds responsible. It sounds like the grown-up move everyone keeps telling you to make. By the time you're staring down retirement, that one signature will have quietly taken $200,000 out of your pocket. You're 25, you don't have a will, and you definitely don't have a plan. Somebody in a suit just made you feel like a bad partner, a bad kid, a bad adult for not being covered. Your paycheck is $3,200 a month, rent already eats $1,200 of it, and now $150 more is about to quietly disappear before you've even thought it through. Here's the question that guy never answers, because his commission depends on you not asking it. Where does your $150 actually go every single month? Not the brochure version, not the pitch, the real math, dollar by dollar. Once you see it, you will never look at that policy the same way again. A slice of your $150 does go toward an actual death benefit, the same job term insurance does for way less money. But a huge chunk gets pulled out before that, mostly in your first 2 years, and it doesn't go toward protecting you at all. Think of it like a subscription where the first 2 payments basically vanish before the service even starts. It goes toward paying the person who sold you the policy. You've probably heard whole life builds cash value you can borrow against later, like a savings account attached to your insurance. That part is true. Here's what almost nobody explains before you sign. If you die, your family collects the death benefit only. The insurance company keeps every dollar of that cash value for itself, and you never get to touch it either. Most people find that out for the first time from a claims adjuster, not from the agent who sold it to them. That guy in the blazer isn't neutral, and he was never going to hand you the boring option that actually saves you money. He gets paid based on exactly what you signed today. Now put that next to term life insurance, the plain, boring option nobody gets excited pitching you. Same 25-year-old, same $500,000 in coverage, healthy, non-smoking, nothing fancy attached. Term life runs about $40 a month for that exact same protection, with no cash value gimmick bolted on. That's plenty of coverage for the years your kids are young, your mortgage is unpaid, or your partner still depends on your income. Same coverage amount, same person, same level of risk. The only real difference is where your extra $110 a month ends up, and who actually benefits from it. So what happens to the other $110 a month you're not handing over to an insurance company? On a $3,200 paycheck, $110 barely registers day to day. It feels invisible. It's the kind of number that's easy to write off as too small to matter, which is exactly why almost nobody bothers moving it. Give it 3 decades, though, and that invisible number stops being small. $150 a month versus $40 a month. For the exact same $500,000 in coverage, on the exact same day you signed up. $110 a month feels like nothing. It's about 2 nights of takeout, maybe a couple tanks of gas. But move that $110 into a low-cost index fund instead of an insurance company's pocket, and let it sit there for 35 years, and something very different starts to happen. Every year that money sits there, it earns returns on top of the returns it already earned, and the gap between the 2 paths just keeps widening. This is what $110 a month, invested from age 25 all the way to age 60, actually turns into once it's had time to grow. $198,000. Say that number out loud, because it's easy to skim past on a screen. That's not a hypothetical, and it's not a sales pitch. That's simply what the gap between $40 and $150 is worth by the time you retire. To put $198,000 in perspective, that's almost 5 years of your entire current take-home pay, gone, just from how you structured one monthly payment at 25. That's a house down payment. That's a decade of rent, fully covered. It's the difference between retiring on your own terms and working a few extra years just to make up for it. Meanwhile, the cash value sitting inside your whole life policy usually crawls along at 1 to 4% a year, if you're lucky. The stock market has historically averaged closer to 10% before inflation, about 7% after it. That gap, quietly compounding for 35 straight years, is exactly where your $198,000 disappears. Try to get out early and it gets worse. Cancel a whole life policy in the first 10 years, and most companies are legally allowed to keep 50 to 100% of your cash value as a penalty. 10 years in, some policies have barely returned half of what you put in, penalty included. That policy was never built around what's best for you at 25, it was built around keeping you locked in. That's the whole mechanism, laid out plainly. A product marketed as protection, quietly structured around a commission, wearing a savings account as a disguise. Here's the part I promised to show you earlier. The actual fix for all of this is almost embarrassingly simple. Buy term life for the coverage you actually need, nothing more. Take the money you just freed up and invest it yourself, automatically, every single month, without having to think about it. If your job offers a 401k match, that's actually the first place extra dollars should go, since that match is free money on top. That's the entire strategy, and it works precisely because it's boring, and boring is the one thing nobody can earn a commission selling. Here's exactly what to do today in the next 5 minutes. Step 1, pull up your policy documents or your bank app and check the type. It will say whole life, universal life, or permanent life somewhere on the page. Step 2, get a term life quote online for the same coverage amount. Most sites give you a number in under 5 minutes, no phone call required. Write that number down because you'll need it for the next step. Step 3, do not cancel the old policy yet. That part actually matters. Get your new term policy fully approved and active first, so you're never left without coverage for even a single day. Step 4, once that new policy is active, cancel the whole life policy and request whatever cash value is left, even if it isn't much. This single swap is the entire trick, and it costs you nothing but 5 minutes of paperwork. Step 5, take that $110 a month you just freed up and set up an automatic transfer into a low-cost index fund the same day your paycheck lands. Set the transfer for that exact day, so the money is gone before you're tempted to spend it. Out of sight, out of your hands, growing quietly in the background while you go live your actual life. If you don't already have a retirement account, that same automatic $110 can go straight into a Roth IRA instead of a random brokerage account, so all that growth comes out completely tax-free when you're 60. You can open one online in about 10 minutes. Most major brokerages don't charge anything to start. Either way, the moment it's automatic, you stop needing willpower to make it happen. None of this happened because you were reckless with money, or bad at adulting, or careless about protecting the people you love. It happened because nobody in that meeting was ever going to explain the mechanism to you. That's the whole point of this channel, showing you the mechanism so you stop paying for things you never agreed to. Once you see exactly where the $150 actually goes, you can't unsee it, and you can't be sold it again. If this just saved you from a $200,000 mistake, hit subscribe, because Money Simplified exists to show you exactly this kind of thing. There's a lot more of this playing out in your budget than just insurance. The system is designed to keep you paying without you ever noticing. Once you see it, you can beat it.